Gold just hit $4,399 an ounce. Here is what the financial media will not tell you. The paper gold market trades somewhere between 100 and 200 times the amount of physical gold that actually exists on Earth. And that single fact changes everything about how you should think about buying it. Today I'm going to walk you through 5 things every beginner needs to understand about gold, in order, starting with why it holds value at all, then how it's actually priced, what really moves it, how to buy it, and the 3 mistakes that cost new investors real money. No filler. Every single point tied directly to where gold sits right now at $4,399.70 an ounce. Let's get into it. Here is the question that trips up almost every new investor. Why does gold hold value at all? It's a metal. It pays no dividend. It generates zero revenue. So what is actually going on under the surface? Most people have never heard the real answer. Gold's value is not really about gold. It's about trust, or more precisely, the absence of trust in everything else. Here is the fact that reframes this. Every single paper currency in human history has eventually gone to zero. Everyone. The Roman denarius, the continental dollar, the Weimar mark, all of them. Gold has never gone to zero in over 5,000 years of recorded human use. That's not a coincidence. That's a track record no other asset class can touch. And right now, the US dollar has lost more than 96% of its purchasing power since the Federal Reserve was created in 1913. Gold hasn't. That's the engine. Number 2, how gold is actually priced. This one surprises almost everybody. When you see the spot price at $4,399.70 today, that number is not set by some free market of people buying and selling physical gold bars. It's set primarily in the paper derivatives market, meaning futures contracts, promises to deliver gold at a future date, traded electronically in enormous volume. Here's the part that stops people cold. Estimates suggest the paper gold market trades somewhere between 100 and 200 times the amount of physical gold that actually exists above ground on Earth. Some analysts put the ratio even higher. What that means is that the price you see is largely determined by financial instruments that may never result in a single ounce of real gold changing hands. That's not a conspiracy theory. That's just how commodity futures markets work. It matters enormously when you decide how to invest, and we'll come back to that. Number 3, what actually moves the price. This is where beginner education usually falls apart. People are taught the simple story: gold goes up when inflation goes up. That's not wrong. But it is dangerously incomplete. The real driver is what analysts call the real interest rate, meaning the interest rate after you subtract inflation. Right now the federal funds rate is 3.63%. US CPI sits at 332.568, reflecting persistent underlying price pressure, and US real GDP growth has slowed to just 1.5%. When real rates are low or negative, gold becomes extremely attractive because the cost of holding it, which is that it pays no interest, shrinks relative to everything else. This is why gold has been on a historic run even as rates stayed elevated. The market is pricing in the expectation that real rates will fall further, and that the Fed's room to maneuver is shrinking fast. And here is a fact even experienced investors get wrong. Gold is not just an inflation hedge. It's more accurately a monetary debasement hedge and a geopolitical stress hedge simultaneously. In 2008, when markets collapsed, gold initially sold off, then rallied over 170% in the following years. In early 2020, when COVID hit, gold sold off briefly, then hit all-time highs within months. The pattern is consistent. When the system is under stress, gold gets sold first to cover losses elsewhere, and then it gets bought hard when people realize the response to every crisis is more money printing. That's the mechanic. Now, the question I get more than any other: where does gold go from here? I want to be straight with you. I don't do price predictions, because nobody knows. But here is what the data shows. Central banks globally bought over 1,000 tons of gold for the 3rd consecutive year running. That's institutional buying at a scale we haven't seen since the 1960s. Slowing growth at 1.5%, elevated prices, a Fed rate the market expects to fall, all of that structurally favors gold. Whether that means $5,000 by year-end or a consolidation here, I genuinely don't know, and anyone who tells you they do is selling something. Drop your honest prediction in the comments. I read every single one. Number 4, how to actually buy gold. 3 routes. Each carries completely different risks. The first is a gold ETF, something like GLD or IAU. Easy, liquid, no storage hassle. But here's the catch most beginners miss. You do not own gold. You own a financial claim on gold. If the financial system seizes up, that distinction could matter enormously. ETFs are useful, but they are paper gold, and remember what we established about the paper gold market. The second route is physical gold. Coins, bars, held in your hand or in a vault you control. This is the form central banks use. China, Russia, India, Poland, all buying physical, not ETFs. The downside is storage, insurance, and the fact that a 1-ounce gold coin will cost you a premium above spot, typically 3% to 8% above $4,399, depending on the product. But you own the real thing, and that premium has historically been irrelevant over a long holding period. The third route is gold mining stocks. Here's the fact that shocks people every time. When gold rises 1%, a well-run gold miner can rise 3% to 5% because of operating leverage. Costs are mostly fixed, so extra revenue falls almost entirely to profit. But the reverse is also true. When gold falls, miners fall harder. And miners carry individual company risk, management, geology, permitting, political exposure. They are not a gold proxy. They are a leveraged bet on gold with added complexity. Understand spot gold first before you reach for miners. Number 5, the 3 mistakes that cost beginners real money. Mistake 1, buying at peak fear. When headlines scream the world is ending, gold premiums spike, dealers sell out, and you end up paying 15% over spot for coins that were 4% over spot last month. The time to buy gold is when it's boring, not when it's on the front page. Mistake 2, putting everything into gold. Gold does not compound. It pays no interest or dividends. Most serious wealth builders treat it as 5% to 15% of a portfolio, a foundation, not the whole structure. Mistake 3, confusing the gold price with gold's role. Gold at $4,399 is not necessarily expensive if the dollar continues to weaken. The price in dollars is not the point. The purchasing power it stores relative to everything else is the point. An ounce of gold bought a fine toga in Rome. It buys a fine suit today. The dollar price changed. The value didn't. Here's your starter framework. If you are brand new to this, do not start by buying anything. Start by watching how gold moves relative to the dollar index and real rates over the next 30 days. Decide what percentage of your savings you want in hard assets, 5%, 10%, whatever sits right with you. Then decide physical versus ETF based on how much counterparty risk you're willing to carry. Then buy incrementally, not all at once. Dollar cost averaging into gold removes the pressure of timing perfectly. It works. If you want a daily lesson like this one breaking down gold and macro in plain English, subscribe and hit the bell. Every video here is built around one specific insight that most financial media glosses over or skips entirely. The goal is always the same: give you enough real understanding that you can form your own view, not just repeat what a headline told you. That's what separates investors who make good decisions from the ones who panic at exactly the wrong moment. One last thing before you go. I'm not a financial advisor and I never claim to be. Most people don't realize that even professional fund managers underperform a simple index over 10 years. So think critically about everything you hear, including everything I just said. Your money, your decisions, your responsibility, that's the only disclaimer that actually matters.